Hey, good morning, everyone. Marty Mazzora here, April 30th, 2021. Quick macro update for you. I'm going to get right to it. In front of you is the PWA index. We are continuing to move nicely with momentum skyward. Wow, that's an exaggeration. 37.5. Although that's a nice score, and that's comfortably above the recession risk line. And of course, you can see accelerating to the upside. Most of it happening in the consumer space, as I'm about to show you. I did mention this morning in the morning note that I might bring up more on the energy space. So let me just do that because I said I might. I mentioned that capacity or the growth in capacity, I mentioned this in yesterday's technical video, was really waning and had waned in the oil patch, like the metals miners and so on. And that didn't see that coming back in a strong way. And then this morning's news from Chevron is that they really did cut capital expenditures, and it showed up nicely in their cash flow numbers. Exxon, however, was expected to, but they didn't. But then they made reference of excess cash flow being used going forward to pay down debt. So what does that mean? And that means that if we do have a continuing rise in economic activity, as our index is suggesting here, and capacity is slow to expand, well, that means higher prices in the commodity itself, right? And as Chevron announced, better bottom lines and consequently better stock prices. So that's that's a big reason why we like the energy space going forward. And it also speaks to other commodities as well. But that little extra on what's going on in energy really comes from an article that was forwarded to me yesterday, or that was brought to my attention yesterday. And it talked about real capacity constraints in the ability to get oil to the stations, or I should say gasoline to the stations. In fact, this article suggested that we may run out in gas stations, or we may see long lines in the summer. The examples they give are driving schools. We're all shut down because of COVID, so we don't have the qualified licensed drivers. Many left the workforce. Many of them were older and just said, heck, we're just going to take this opportunity to retire. So what the industry is very concerned about is the ability to actually get gasoline to the destinations. The article also noted that hotel bookings are off the charts, but airline bookings aren't. So people look like they're going to be driving a lot to their vacation destinations this summer. So again, just more weirdness that ultimately equates to near-term higher prices, substantially perhaps. The big debate that we'll continue to have on the blog is, whether this is, cyclical, transitory inflation, as the Fed would like us to believe, or is there some structural stuff going on? I'm getting deeper into those weeds with you. I just kind of hinted to some of the global demographic changes and policy changes in places like China that, the last several decades, the mode of operation there really spelled global deflation. That's changing, and we should expect counter moves or very different moves in terms of dynamics like inflation going forward. So the world is changing, as we know, and it is going to show up in the prices of goods and services. All evidence points to that right now. And then there's ways to accommodate for that in portfolios, which is what we're doing actively for you clients. Although today, and I'll one more on markets and so on, and then I'll really get to the data. Today we had Fed Governor Kaplan do something that Fed Chair Powell is very reluctant to do, and that's hint that maybe there is something to this inflation narrative, and maybe we should kind of slow down this bubble a little bit. That sent the dollar through the roof right off the bat. And of course, that sent things like our commodities exposure and the stock market down. And as I showed you in the charts of the day a little while ago, it didn't reflect on the bond market. So the bond market, which is one of the most skittish places to invest, careful, defensive, doesn't seem to believe much about that this morning. And I think that's logical, because if indeed they were to tighten monetary policy and that were to reflect in lower bond prices and higher yields, that could set up a chain reaction. In fact, the higher dollar is exceedingly problematic when you look at where the dollar denominated debt sits the world over. So it makes sense that they begin kind of trying to build some credibility, saying they're looking at these things. We're not just discounting all of it, but the notion that the Fed will agree on that board to tighten monetary policy anytime soon would be really something to see, because make no mistake, it would have a dramatic negative impact in asset markets if asset markets are going to continue to trade what they've been trading on since the COVID nightmare, and that is policy, money printing, free money ad infinitum. We know that's not the real world. That's the fiscal cliff that we need to start worrying about at some point when they begin to pull back from that. But that's not happening tomorrow. So it'll be interesting to see how the market digests this. But again, less than a 1% sell-off in stocks, that roughly, maybe a little more in commodities, nothing in bonds. Folks, this is nothing at this juncture to panic about, but I'm going to continue to point out the risks, and we're going to continue to hedge against something deep to the downside. Okay, I meant to do this quickly. Again, index looks good. Move that out of the way, get to a few data points, and then wrap up. So take a look at this personal income number right here. Just absolutely off the charts, right? Keep in mind, though, base effects, right? So 29% year over year. Okay, yeah, but where were we exactly a year ago, right? Well, we were in the dumper. But on a month over month basis, it's very impressive as well. So, just relative to last month, but notice what you're seeing in here, right? You get the, get that out of the way. You know what this is, right? 1, 2, 3. How many stimulus checks have people gotten so far? 3. So are we going to get this next month? Of course we are. So is this going to hit consumer spending in a big way? Of course it is. Let's take a look. And here are your consumption expenditures. There's the rate of change, there's the move, and so on and so forth. So good, positive stuff. And consumer confidence is really bounding to the upside. So this makes some sense, but that one-off stimulus checks really distort the data, as do the base effects if you're comparing things on a year-over-year basis. Consumer savings rate, this surprised me, jumped 27.6%. To 27.6%. That would be viewed as a negative by economists, right? So a chunk of that money, apparently the stimulus checks, got forced into savings. So tell you, that's really good news, because as the economy heats up and people get confident, that number is going to drop exponentially, and it's just going to be more fuel for the economy. I sympathize with that. It also will be more fuel for inflation as well. Durable goods orders, again, remember, year over year off the charts, 26% increase in durable goods, big increase, 12% ex transportation, which is good to look at. But look at it here, 1.6% month over month. That's a nice move. But you can get all excited about this kind of stuff and say, what is going on? Remember where we were a year ago. But month over month, of course, that's a pretty nice move as well. Heavy truck sales, that's good to see. We are undersupplied with trucks relative to this, heat up in demand, and truck drivers in the gasoline space, as I just mentioned at the start. So yeah, that's a good thing. That scored positively on our index. Inflation, the PCE. Because that's supposed to be the Fed's chosen measure. It's 1.8%, so it's approaching their 2% target. Many people say that the Fed's just kind of kidding themselves if they think they can create some inflation. I don't think that's been what they've thought since the beginning, when they said they're going to let it run hotter than 2% in a while to catch up for all this underperformance, right? I think they're afraid that's going to happen, and they know if they tighten, like Fed Chair or Fed Governor Kaplan said they should, they know, like today, although today's not a big catastrophe in asset markets, but it's a hint of what would happen if indeed the Fed actually did that. CPI, year over year, 2.6%, that's hot. X, food and energy, two things that we spend most of our money on, ironically, not quite so hot, right? Producer price index, boy, that's going up as well. So anybody who says there's no inflation is insulting our intelligence. Anyone who says it's transient, that's an intelligent argument. If they really dig down below the surface, it may look transient. We may see inflation kind of slow down and cool off the second half of the year. I'm talking about the longer term fundamental changes that we're seeing in the world that I think could lead to a somewhat steady rise in inflation in the years to come. But time will tell. That's a nice narrative for our commodities exposure, but I'm not wedded to any of it. That's just what the data and the trends are suggesting to me at this particular moment. Still on inflation, these are inflation break-evens, the difference in yield between the nominal treasury bond on a the 2-year is the yellow line, the 5-year is the blue line, the 10-year is the white line. So all, well north of 2% is what the market is demanding as compensation at these tenors for inflation, right? And you can see what that move looks like. So you can say this is inflation expectations, and that's moving in the direction that we would expect it to, given our broader thesis. The Bloomberg Commodity Index, that bull flag pattern is working perfectly. Remember, we're looking at a move that would equate to the flagpole if this technical pattern plays out. So commodities, it says here, have a lot higher to go, despite the fact that they're selling off a bit today. That's that little tick in the other direction here. We'll see. Makes sense given our overall narrative. This trajectory, the angle here does not make sense. I said this in yesterday's technical video when it came to ag. Expect a sell-off. We're getting some of that, ironically, today. If only technical. But again, the dollar's really pounding higher today, so that's doing a number on commodities for sure. Industrial metals, this is what goes into everything that we think is going to be happening in terms of infrastructure going forward. You can see the market is discounting higher prices, and of course you have the bottlenecks, you have the lack of capacity in mining and so forth that I think is going to stay for a while. So again, too steep to last. Most angles are going to be more at this angle here. But again, that makes sense in the context of what we're seeing in the world. Don't expect these kinds of gains though. On a consistent basis. There's certainly not that sort of, momentum or velocity to the upside. And then copper prices, that bull flag is working perfectly. Remember here, flagpole. So we're about seeing pretty close to where that price target should be. Copper is selling off a bit today, I believe, like everything else. But again, this one, as I said, it's been kind of flagging higher here for a while. But again, that's too steep. That's not going to last. If I were just short-term swing trader or short-term day trader, I would probably short copper right here for a little bit, even though I'm very bullish on the metal long-term. And just a little more texture there. Just think in terms of what's needed and what's desired going forward. We know there's going to be a few $100 billion or possibly trillion spent on infrastructure, but that's over the next few years. So that's going to be met with a great deal of fanfare. But remember that spending is going to be spread out over a period of time. And if they think they're going to be able to couple, big tax increases along with, the announcement of a infrastructure bill, I don't think the market's going to buy that, because suddenly, when I saw in the proposal, it's about $150 billion a year in increased corporate taxes, and you may not get that much spending on infrastructure. And of course, it's not a one-for-one, and we don't seem to get the multiplier effect from all this government spending like we might have, or like we certainly would have if the economy were in a different place. The rally in metals, it's really coming from a couple of sources. You had the global supply constraints, that we've been talking about. I've talked about the fact that we've been in a real commodities bear market for the last 10 years. So you've got some pent up willingness to buy, lack of capacity. You've got this recovery from COVID. But again, we've got a long-term push in front of us in the electronic vehicles, for example. The metals use in the batteries, of course, and we have a lithium miner, we have rare earth miners in our portfolio. But just copper, copper is the most ubiquitous metal of all, and it's used big time across the board. In fact, there's more copper in the manufacture of an electronic vehicle than there is a gas-powered vehicle. So these trends are somewhat cyclical, somewhat situational due to bottlenecks and coming out of COVID, somewhat technical due to coming out of a 10-year bear market, but very fundamental if you look at where a lot of the push and a lot of the government incentives and things are going to go going forward. But when we get these big runs, again, we're going to have great relative performance for a while because we're in these things, and then we're going to have, somewhat underperformance for a while, depending on what you compare to, when they correct and when they come down. And you want them to do that. That's what makes for a safer, longer-term move and something more sustainable. I guess that's saying the same thing. So we like where we are, and that's right now, folks. Call it a fourth, just under a fourth of our portfolio exposure is directly to commodities, and then lastly, and then I'm going to let you go. Baltic Dry Index. This is ridiculous, right? This is the cost of shipping bulk across the world's oceans. Typically you'd say, wow, that just says great things about global activity. Probably does, but it probably says more about huge deficiencies in the ability to transport goods even across the world's oceans. So that looks like inflation to me. But again, we're going to continue to weigh the both sides of that story. Is it short term? Is it long term? Stay on our toes, really, really pay very close attention to all of the data as it comes out, and act accordingly within our portfolios. Thank you as always for watching and listening. Hope you have a fantastic weekend. Talk to you again soon. Bye-bye.